Good morning and happy Wednesday, you wonderful melonheads. I hope you guys are well. Today is April 19th, 2023, and the big story this morning is real estate. We got some data from Redfin, we got some data from the Mortgage Bankers Association, not painting a pretty picture for real estate. Inventory remains tight, home prices moving lower, 3.3% drop in the median home price in the United States for the month of March. That is the biggest decline since 2012. It's only the second decline since 2012, following the last month's data where home prices fell 1.2%. So prices are still falling, and that fall is accelerating. Now, the real estate market, the housing market, is not even the real big vulnerability in the economy right now. We've got bigger problems brewing in commercial real estate, something we've talked about a lot on this channel, and there's a lot happening in auto loans, something we may be talking about later today on this channel. I don't know what is going on in auto loans, but now we're seeing it in homes. 3.3% drop in the median home price in the United States. And we've got certain metro areas are just being absolutely clobbered right now that are really dragging on that average. But look, the big deal here is affordability. And we're seeing this in both cases. People cannot afford to buy new homes, so they're not even trying. People can't afford to buy new cars, so they're not even trying. And of course, without affordability, you don't have buyers, you don't have liquidity in the market, and that makes the market very vulnerable to any kind of disruptions. We're seeing that across the board. Elsewhere, we've got Morgan Stanley reporting this morning, and the initial media headlines were just glowing. Oh, Morgan Stanley beats estimates. Yay, Morgan Stanley. Not so much. 19% year-over-year decline in profits for Morgan Stanley, and they have quadrupled their loan loss provisions, citing commercial real estate as the reason for setting aside cash for people not paying their bills. Not very good. And then across the pond, another big story going on this morning. Inflation in the UK came in at 10.1%. The big culprit over there was food prices in the UK continue to drive inflation higher. And the UK gilt market, interest rates on bonds in the United Kingdom, blowing out higher this morning. And if you recall, last November, high interest rates in the UK gilt market, when they hit around, I think it was 4.2 to 4.5%, very bad things happened in the pension system over in the UK. Well, we're getting closer to those numbers now, especially after this big move this morning. So with that, let's shrink my big melon of a head and see what is going on in markets right now. We've got the S&P 500 down about 17 points or 0.4% at 4,138. The Dow is down 46 or 0.14% at 33,930. And the NASDAQ leading the way lower, down 78 points or 0.64% at just over 12,076. The NASDAQ was down over 100 pre-market, so it's looking a little better than it was earlier today. We've got the DXY is all over the place this morning. When I first opened my eyes this morning, the Dixie was sharply higher. And then, of course, we got that big UK inflation number. And then ever since the UK inflation number came out, the Dixie has been moving steadily lower, pretty much right where we left off yesterday, currently up 18 basis points at 101.92. Over in the bond market, we have got the long end of the curve. Things are looking a little bit higher. And the short end of the curve, things are looking a little bit lower. The 10-year yield is up 4 basis points or 1% at 3.61 this morning. And the 2-year is up 4 basis points or 4.24%. Not huge moves in the U.S. bond market. Moving over to commodities, we've got gold getting a little bit of a price smash this morning, down $20 below that all-important 2,000 level. A lot of that has to do with that big spike we saw this morning in the DXY. Again, some of that is giving back some of those losses right now. Gold is clawing back, trying to get back above that 2,000 level as the Dixie falls. Silver also, silver's looking pretty good now. Back to even at 25.26. Silver was well below 25 earlier today, so silver's recovering some of those losses. Crude oil at 79.58, down $1.30 or 1.58%. And natural gas at $2.25, down about 12 cents or 5% this morning. Moving on over here, let's talk about this one. This is the big story this morning. This is in Redfin. Home prices fell 3% in March, the biggest annual drop in over a decade. We've been talking about real estate on this channel for a while now. We've been saying, look, it wasn't crashing. The market was frozen. Prices are so high, interest rates are so high, nobody could afford a home. And so nobody was buying, but also because nobody could afford to buy anything else, nobody was selling. So everybody was just kind of paralyzed. The market's just not moving. While we're finally starting to see downward movement in prices, I suspect this has a lot to do with the surge in layoffs that we saw starting in January. Here we are in April. People who lost their job a few months ago, those houses are finally starting to hit the market. I expect this is going to continue for quite a while now. Pandemic boom towns and pricey coastal markets, including Austin and San Jose, saw among the largest price declines. In many more affordable areas, prices continued to climb. That's important. In many more affordable areas, prices continued to climb. So I want to kind of temper some of the doomer gloomer rhetoric here. There are still local markets that are doing very well. Real estate remains a local trend, a local phenomenon, but overall the trend is down. Pending home sales dipped to the lowest level since the start of the pandemic as elevated mortgage rates curtailed buyer demand and a lack of homes for sale limited purchases. New listings also fell to the lowest level since the pandemic onset. There's that lack of inventory, that market being frozen. People are afraid to list unless they absolutely have to. Homeowners stayed put in order to hold on to their low mortgage rates. A shortage of supply caused bidding wars to return in some markets. Median U.S. home price fell 3.3% in March to $400,528, the largest year-over-year drop since 2012. That follows February's 1.2% dip, which was the first annual decrease since 2012. And I want to show you this chart. It's a little bit blurry when you blow it up, but this kind of shows you what's going on. This chart goes all the way back to 2012, and we're looking at the red line here right now. That is the national median sale price. All right, the median is where most of the homes lie. It's not the average, because the average would be the mean. That's when the big McMansions, they screw up the mean. The median is where most people live. So the median price, this is the second decline since 2012, but the biggest one. And you can see here, we peaked in 2021. Home prices have been falling. They're continuing to fall, and the fall is accelerating, getting deeper and deeper into negative territory. And with layoffs still on the rise, unemployment on the rise, remember that big revision to jobless numbers a couple of weeks ago that we talked about on this channel? I expect this red line is going to continue deeper into negative territory. And now you've got a couple of local areas they're shown here in blue and orange. What is going on in Boise, folks? Do I have any Idahoan melonheads on this channel right now? Can somebody tell me what's going on in Boise, Idaho, that the market is tanking like this, down almost 15% on the median home price? I had no idea things were going on in Boise. So someone let me know in the comments what is going on down there. Elsewhere this morning, the Mortgage Bankers Purchase Index, this one came out. The MBA Purchase Index, this measures the number of applications for a mortgage, and it decreased 10% to a 6-week low of 161.6 for the week ended April 14th. Now you can see we're not quite as low as we were back in February. We were a little bit lower, but we did see a surge in demand with some lower interest rates earlier this year. That is now weighing off. And shout out to my moderator, Mish. He caught this one. When we zoom out to a 25-year chart on here, you can see right now down here where we're at, around the 160 level, we're back into GFC levels here, folks, on the MBA Purchase Index. So prices may not be at GFC levels, and a lot of that has to do with the limited inventory, but the number of sales, the number of people applying for mortgages, those are in GFC territory. And the longer we stay down here, the more likelihood that prices come down to match it. And as those layoffs continue to pile up, especially in tech, especially in those Western markets, better watch out. Those home prices will be coming down further. Moving on, we've got Morgan Stanley profit beats estimates on wealth business strength. Well, doesn't that sound just fantastic? No, not so much. Morgan Stanley's first quarter profit beat expectations as rising revenue from its wealth management division offset declines in its investment banking and trading units. Shares, however, fell more than 2% in pre-market trading. Revenue from investment banking fell 24% to $1.25 billion, while wealth management saw an 11% jump to $110 billion. So what's going on here? Well, investment banking has been hurting this year because there's no IPOs. There's no big mergers and acquisitions happening because interest rates are so hard. So that's hurting their investment bank. Now, Morgan Stanley saw a bump in wealth management revenue because a lot of that money that was running from the banks went into money markets that are managed by who? Morgan Stanley. So they were the beneficiary of a lot of that capital flight out of small and regional banks. A lot of that money went to Morgan Stanley. But you have to scroll all the way down here. Where is it? Here we go. This is the meat and potatoes of this report right here. Morgan Stanley set aside $234 million in the quarter compared with 57 million a year ago, bracing for deterioration in commercial real estate and customers potentially falling behind on loan payments amid rising costs of borrowing and recession worries. Their loan loss provisions quadrupled in this report. They are bracing for economic mayhem in commercial real estate. And of course, that has their earnings down 19% year over year. So while the headlines might be, hey, they beat estimates, great, you got to look at the numbers. You got to read beyond the headlines. It's not all unicorns and rainbows over at Morgan Stanley. Morgan Stanley stock down $2.46 right now, or 2.74%. Another big story this morning, UK inflation. Food prices rise at the fastest rate for 45 years. This is not so good, folks. Sorry for you guys over in the UK. Soaring prices for bread, cereal, chocolate meant the cost of living rose more than expected last month. Inflation, which measures the rate of price rises, fell to 10.1. Let me start that one over. Inflation, which measures the rate of price rises, fell to 10.1% in the year to March from 10.4% in February. So inflation was 10.4. It's coming down 10.1. Problem is they were expecting it to come down way more. And also, before somebody reminds me in the comments, I have to reiterate, inflation falling does not mean prices falling. Inflation falling means prices rising slower. Prices are still rising at an alarming rate in the UK, 10.1%. And food is the big culprit. And that's particularly bad because food hurts the most vulnerable among the population the hardest, who spend a bigger percentage of their income on food. And that is dangerous, folks, because look at what's going on in the UK bond market right now. Yields on UK gilts are up across the board, and they're up big. The UK 10-year gilt is up 13 basis points right now, 3.5% rise in yields at 3.87%. Look at some of these moves. The 4-year gilt up 15.5 basis points. The 2-year gilt up 14. All right, interest rates in the UK are surging right now. They're expecting the ECB to stay tighter for longer because of this higher, not the ECB, the Bank of England. They're expecting more interest rate hikes from the Bank of England, as higher inflation means a more aggressive central bank. But the UK has a problem. Remember, at 4.2% or 4.5%, somewhere around there, that's when something broke in the UK's pension system. So what do? Do they raise interest rates and break something in pensions again? Or do they leave interest rates down here and let people keep suffering from 10% inflation? Well, that is the problem facing central bankers around the world. Another one going on, Netflix delays password sharing crackdown rollout and posts mixed results. Bad news in Netflix earnings yesterday. So they rolled out this crackdown on password sharing in some other countries. It did not go well. When they cracked down on password sharing, people canceled their Netflix accounts. Netflix was hoping people would sign up for new accounts. That did not happen. So Netflix is now saying we're going to have to delay the rollout of this plan here in the States. Why? Because, well, we don't want to lose subscribers here in America. And it turns out when you don't let people share their passwords, they don't go sign up for new accounts. So Netflix is learning the hard way that they don't have the pricing power that they thought they had in their market, and it cost them subscribers. They missed their subscriber additions rollout. Even though it was a halfway decent earnings report, the subscribers were not there, and Netflix is paying for it right now. Their stock is down 4.7% this morning. They were down as much as 12% after hours yesterday. So things could be a lot worse for Netflix than they are, but things in the streaming side not going so well. And I got a couple people I got to say thank you to this morning. Where are you guys? You wonderful, magnanimous melon heads, you. I'm going to find you first. I have got, well, hello, Jamie Irish with the super sticker. Thank you very much. Enjoy your walk, Miss Jamie. I appreciate the super chat and the support of the channel very much. And Mr. T-Spin is here. He says, thank you, T-Spin. He says, thank you for the continuous updates, Jack. You are most welcome, T-Spin. I absolutely love this job. I will do this forever and ever and ever, as long as the good Lord lets me. Thank you very much for the support of the channel, Mr. T-Spin. And thank you, EC660, who has crawled out from under his rock again. He says, what? Who? Never mind. I'm going back to sleep. That is our resident Patrick the Starfish, EC660, who has just come out to be a generous fella, and then back but underneath the rock he goes. Don't worry, EC, we'll wake you up when all this financial mayhem is over. All right, guys, I want to say thank you very much for all your super chats and support of the channel. Thank you to my Patreon supporters. Looking forward to talking to you guys at 3 p.m. Eastern Time today for our weekly Zoom call. We have got a lot to talk about today. There's so much going on in the world. So many stories. I was going to try to squeeze into this stream, but I couldn't. I try to keep these short because I value your time. So I will talk to you guys on Patreon in just a few hours. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.